Good morning, everyone, and a very warm welcome to July's edition of the 10-minute market forecast. I hope everyone's doing well and you're all having a very pleasant summer. My name's Jordan, and I'm the Strategic Business Manager for Blackfinch, and I'm delighted to be here with you today, alongside Josh Clayton, who is our Product Specialist for Listed Investment Solutions. For those that are joining us for the first time today, in this webinar, we explore what's happened over the previous month, and we consider how the current economic climate and conditions across the globe could impact markets going forwards. It's our hope that by shedding light on these current events, that you can take away a good number of sound bites to share with your clients. You can submit questions prior to the webinar if you've got any specific points you'd like us to cover, which will be on asset allocation views or perhaps outlooks for particular regions. You can also do this by sending an email to my team's email address, which I'll share with you towards the end of today's webinar. Today, we're going to focus our attention much closer to home and start by looking at the political environment in France, so with the European election results, and what this means for European equity and fixed income markets. We'll also cover the UK and the US with the key economic data points to look out for coming out of both those areas. Finally, Josh will cover our near-term outlook, our current positioning, and the opportunities we see for our portfolios going forwards. Now, we may slightly run over the 10 minutes because there's a good amount for us to cover this month, so I think it's best we get started. So now I'll pass things over to Josh. Josh, good morning.
Thanks, Jordan, and a very good morning, everyone. Thank you for joining this webinar and tuning in today. Now, as Jordan's outlined, I thought we need to talk geopolitics before we dig into anything else, as we've really seen some volatility come through in pricing over June. And with so many elections going on over the year, politics is likely to shape the market narrative, especially over the coming quarter. So for those of you that have been following the news, French President Emmanuel Macron had a dismal performance in the European Parliament elections on the 9th of June. So he called for a snap election, all in the hope to discredit Le Pen's populist National Rally as a serious party of government. Now, Le Pen's party won about 32% of the vote, which is more than double that of Macron. And we've already had the first round of voting on the 30th of June. And the second takes place on my birthday, which is the 7th of July. And that's just a few weeks before the Olympics starts in Paris. Now, the call for the snap election completely threw investors. And the CAC 40 or the CAC 40, which is the stock market index that tracks the largest French stocks based on their market caps, fell 6% practically overnight. And then it continued to draw down afterward. And spreads between French and German bonds hit levels that haven't been seen in about 6 or 7 years. And before we dig into it further and think about why this may have happened, don't forget that this geopolitical risk isn't a new phenomenon. We've already seen the surprise results in India election in mid-June impact Indian markets. Of course, we've got the UK election on the 4th of July and the US election later in this year. But in terms of the snap election specifically, it took so many people by surprise, and it's seen as a huge risk that Macron just didn't have to take. He theoretically had until 2027, until the next vote, and some theorists out there are saying that he's done this to let Le Pen win, form a government, and hope she becomes even more unpopular than Macron before the 2027 vote. And the first round has shown that the hard right and left have beaten Macron, who's currently in third place, and has a chance of a bit of gridlock here, which doesn't sound too good for French investors. Now, the key impact on markets and why this caused so much volatility is that he lost his majority in Parliament just 2 years into his second term. And we know this means his government will struggle to pass laws, this can feed into decision-making, and possibly affect that all-important economic growth figure that many other countries look primed to extend this year and beyond. Now, this is going to be a key consideration for July in our view, and for the rest of the year. Will we see a similar reaction by bond markets as we did when we had Trussonomics in 2022 and that disastrous mini budget, or is it something more longer lasting? Now, as money managers, we need to consider the political risk and whether we're seeing structural shifts in an economy that could lead to policy changes. But holding a diversified multi-asset portfolio can help alleviate some of those near-term burdens and capture any changing trends across the globe. And active management absolutely plays a vital role here. But if we pause on France, go over the English Channel to the UK. Now, I think there weren't really any real surprises over June. We had the Bank of England leave its key interest rate unchanged at that 16-year high at 5.25%. 7 members of the Monetary Policy Committee voted to keep rates steady, but 2 backed a cut to 5%. And some members said the decision was finely balanced, potentially signalling that policymakers are drawing closer to reducing borrowing costs this year. And I think that we can all agree the time's upon us for an interest rate cut at this point, with so many signals hinting at this now. And markets are pretty much pricing in a cut on that 1st of August meeting. And just to touch on inflation for the UK, the headline rate dropped to the central bank's target of 2%, and that's down from 2.3 the month before. Core inflation, which excludes food and energy, eased to 3.5% from 3.9 in April. However, it's services inflation that's the sticky component here. And this is the same for many other developed economies as well. It was reported at a reading of 5.7%, and that's higher than consensus expectations. We've been seeing wage growth stay incredibly robust against this inflationary backdrop, and this is feeding into the services component as consumers have more money in their back pocket to spend. But moving on to the UK election this Thursday, we expect to see less volatility than that of France, as the situation here is much more clear-cut. Typically, general elections will affect stock markets due to the uncertainty around their outcome, but the UK shows a clear margin of victory in favour of Labour and Keir Starmer. And their proposed policies almost feels a bit steady as you are for the near term. They're proposing corporation tax is going to remain at that current rate of 25%. And the focus is more on additional tax rate payers. So VAT on private school fees, and there's reform on non-dom rules as well. Of course, this is politics, so anything can happen. Certainly keep an eye out on that date for UK markets. But as we say, less volatility than that of France. Very quickly on the US, it doesn't look like it's all doom and gloom for the country. We saw reassuring inflation data come through. The Labour Department reported that headline CPI was flat in May, and that's the first time in nearly 2 years. Core prices rose 0.2%. That's a tick below expectations and a 7-month low. And on a year-on-year basis, core inflation fell to 3.4%, the lowest level since April 2021. But that inflation data didn't really do anything to sway officials, and they left that Fed funds rate unchanged, which was expected. But what I thought was really of note was that they increased their median expectation for the federal funds rate at the end of 2024 significantly. And that's from 4.6% to 5.1%, which would imply only one cut later in the year. In their post-meeting statement, however, Fed officials did acknowledge that there's been modest further progress on inflation versus a lack of further progress, which was in the 1st of May post-meeting statement. But moving on, I've got a lot of key political dates to look out for early on. And as we said, not much volatility. We expect not much for the UK this Thursday, but it's the 7th of July for France. So all eyes on the following Monday when markets open. And then, as we said in the past, markets are still very much driven by macroeconomic data at the moment. So keep an eye out for these dates I'm about to cover for potential upside or downside market movements. So we have US inflation and core inflation print on the 11th of July. As I mentioned before, there's some encouraging news on this front for the previous month. So investors are going to be watching very closely to see what happens here and if this is going to sway the Fed's mind on rate cuts. We then have the 18th of July for the European Central Bank's interest rate decision. I'm sure, as you know, these were the first major developed central bank to cut rates. All eyes are going to be on them again to see if they cut a further 25 basis points or if they want to wait it out before going again. And we have the Fed on the last day of the month and the Bank of England on the 1st of August. And as I've hinted at, it looks more likely for the UK to go before the US with current conditions. And I'm conscious of time, but I wanted to cover Blackfinch's near-term outlook and recent activity for our portfolios. So inflation appears to be slowly unsticking itself, but global central bankers are still concerned over services inflation. Typically, if goods prices remains low, then the natural next step is that services inflation should follow suit, meaning a soft landing could be a baseline scenario and a broadening out of economic growth is plausible, and then we can see those subsequent interest rate cuts across developed economies. Of course, at the moment, we still have tech that's driving returns. It's led by the US as well as India, and this earnings growth could be maintained as AI continues to drive operational efficiencies. So this renewed disinflationary and falling interest rate environment can be supportive for smaller companies in our view. And this is a trade we're looking to make use of for this next part of the cycle. And we're putting some more cash on the table, so to speak, which are currently held in short-dated cash funds in order to fund it. And as well as that, we're taking some of that cash to move into short-dated bonds. Now, this increases our duration exposure, which we believe to be a vital role as interest rates start to fall. And we're maintaining our conviction in gilts and treasuries, which look attractive at current levels. And we believe that further infrastructure and property investment could be supportive going forward, as many of these companies are capital intensive and they rely on financing for forward projects. And of course, this feeds into the falling interest rate narrative. Minute over, but I believe that covers everything from my side. So Jordan, I'll pass back over to you for the wrap up.
Well, thank you, Josh. It's really good stuff there. And thank you, obviously, to everyone that attended with us today. I hope you enjoyed it and come away with a good number of points that you can share with your clients. As always, if you do have any questions on any of the elements that Josh covered today, or anything we might not have touched on, then you can contact me and my team by sending an email through to strategicteam@blackfinch.com. That's strategicteam@blackfinch.com. I will make sure to come back to you as soon as we can with any answers you're looking for. Our next market forecast will be taking place on Tuesday, the 6th of August at the same time of 8:50. I'm sure post-election there's going to be plenty of exciting things that we'll be looking to cover. But for now, I hope you have a positive start to your days and look forward to seeing you next time. So bye for now.
Thank you, guys.